So are we in an AI bubble right now? Is this anything similar to the dot-com bubble from 2000? Is the stock market really overvalued? And if it is, what can you do about it? Today, I'm going to share with you 3 key metrics which are flashing warning signs that the market is very overvalued right now. And then I'll also cover 3 major stressors on the economy which can cause a recession at any time. And most importantly, I'm going to talk to you about what you can do with your portfolio today to protect yourself if there is a recession and still benefit if the market continues to go up. Hi, and welcome to the Money Matters MD Show. I'm Dr. Abhishek Gadre. I'm a practicing physician and I help high-income professionals like you take control of your money. So let's talk about stock market valuations right now. There are different numbers that you can use to predict the valuation of the stock market right now. Now, think of the stock market as a huge, thick rubber band. And the valuation metrics are the number which tell you how stretched thin this rubber band is. Now, the more stretched thin the valuations are, the more stretched this rubber band gets. And even a little unpredicted stressor can stress this rubber band enough to cause a massive market correction and the rubber band just comes apart. Now let's talk about the first market valuation metric called the PE ratio. So a PE ratio is a simple ratio between the price of the stock to the earnings per share. Now, if you're evaluating the market on a more zoomed out, on a more long-term decades basis, you want to use a Shiller PE ratio in which it uses the 10-year earnings instead of just 1-year earning. The Shiller PE ratio is also called the cyclically adjusted PE ratio or the CAPE ratio. Now, if you look at the historic average CAPE ratio for the S&P 500, it's around 20. And as of June 2025, which is the latest data available, the Shiller PE ratio or the CAPE ratio is around 38, which is really high. Now on the next slide, you will see how far off we are right now from the historic market average. The Shiller ratio of 38 is around 2 standard deviations higher than the historic market average. We are in dangerously overvalued territory. The only last time we were so overvalued was in the dot-com bubble in 2000. In the dot-com bubble of 2000, the NASDAQ index fell down by 78% within 2 years from its peak to its lowest point, from 2000 to 2002. Now you can use a trailing PE ratio when you're looking at earnings from the past. And if you want to look at earnings for the future and project the future PE ratios, there is something called a forward-looking PE ratio in which you can use the price to earnings, but the earnings in this part is the future projected earnings. That's where speculation sets in. Now, every single time a particular company releases its earnings reports, depending on if the company met its expected earnings, the stock can fluctuate heavily. The YouTube analytics tell me that a lot of you viewers are not actually my subscribers right now. If you would like to support my channel, please hit that subscribe button and like and share my video. Now the second valuation metric is the Buffett indicator. It's named after Warren Buffett. So what a Buffett indicator is a ratio of the current total market capitalization of the US stock market divided by the US GDP or the gross domestic product. So what the US total stock market capitalization tells you is based on what the market predicts the future growth and productivity will be, and the GDP tells you retrospectively what the current productivity is. And this ratio tells you how speculative the market can get. So as of right now, the Buffett's indicator is more than 2 standard deviations higher than the historic average. It is also predicting that the market is extremely overvalued right now. Now, as you can see from the graph, the Buffett indicator spiked before the 1970s Nifty 50 bubble and also spiked up before the dot-com bubble crashed in 2000. Now, the third number I want to talk about today is a concentration risk. The S&P 500 has 11 sectors and technology is just one of them. Historically, the technology stocks have occupied around 15 to 20% valuation in the S&P 500, but right now they're around 30 to 35%. We are really top heavy right now in the S&P 500. The top 10 mega cap companies occupy more than 30% of the valuations within the S&P 500. That means the rest of the 490 companies occupy only less than 70% of the entire space. Now, scroll down below and comment if you think the market is overvalued right now. Or do you think the market is fairly valued and the AI rally is just going to continue? Now remember, reversion to the mean is a time-tested principle over the last 100 years of investing. And that is why you need to be careful. Now let's talk about 3 different factors which are really stressing the economy right now. The first one being the high federal interest rates. Now, higher the interest rates get, it kind of acts like a gravitational pull towards growth. Higher interest prevent strong growth because it's harder for companies to borrow money. The second stressor is the tariffs. Higher tariffs on foreign countries make it expensive for goods and services to be produced by the US companies. And that eats up on the profit margins. Now, the third and biggest long-term stressor for the economy is the changing world order. In fact, Ray Dalio wrote an entire book on the changing world order, which is an excellent book, and I'd highly recommend you read it. It talks about how the US dollar is weakening and eventually other economies like China and India will take over in the coming decade. Now, what can you do right now if the market is so overvalued and possibly reaching AI bubble territory? Well, it's simple. The answer is diversification. Most investors right now are heavily invested in the right upper quadrant of the economy, which is large cap growth. A simple way to diversify against that would be add more balance on the left column, which is the value segment of the economy, and adding maybe a small cap index fund as well. Maybe even consider an international fund and adding some bonds to act as a ballast if stocks really do go down. Watch my next video in which I share specific funds which are my favorites for this very purpose. Now, here are some take-home points. No one knows the future, but you don't want to live under a rock either. The CAPE ratio and the Buffett indicator are both more than 2 standard deviations above their historic averages. And they both say the same thing, that the market is extremely overvalued right now. The technology sector and the mega cap companies are making the S&P 500 extremely top heavy right now. You think you're buying into an S&P 500 fund, but what you're really getting is top 10 mega cap technology companies. The economy is under a lot of stress from tariffs, high interest rates, and the weakening dollar. Reversion to the mean always wins. And diversifying your portfolio is the only free lunch. You need to add some protection to your portfolio, and I'm going to talk about exactly that in my upcoming video. I'm also going to share the specific ETFs and mutual funds which are my favorites to diversify against such a bubble risk. If you learned something useful today, please subscribe to my channel. Thank you for watching. Money Matters MD, over and out. The Money Matters MD show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice.